I'd like to talk about the securities markets, how they function and how they're organized. First, a market is simply the way that buyers and sellers are brought together to aid in the transfer of goods and services. A market doesn't have to have a physical location. It's only necessary that buyers and sellers can communicate with each other. Also, a market doesn't necessarily have to own the goods and services involved. What's important is that there's a smooth and relatively inexpensive way to transfer those goods and services. And finally, typically a market deals in a variety of goods and services. Now let's look at some of the characteristics of a good market. First, in a good market, there's timely and accurate information that's available on the price and volume of past transactions. Second, a good market is liquid. This means that an asset can be bought or sold at prices close to the prices of previous transactions. This assumes that no new information has been received by the market since the previous transaction. Liquidity requires marketability. This means that there's a good likelihood that the asset will be sold quickly. This in turn requires depth. This means that there have to be potential buyers and sellers who are willing to trade at prices above and below the current market price. Third, a good market needs low transactions costs. That means the cost of reaching the market, the actual brokerage costs, and the cost of transferring the asset all have to be relatively low. And finally, in a good market, the prevailing price should reflect all available information about that asset. Investors want prices to adjust quickly when there's new information regarding supply and demand. Now, let's look at the organization of the securities market. The overall organization in securities markets, we have primary markets and secondary markets. In primary markets, new securities are sold, brand new securities. This is where new issues of bonds and new issues of preferred or common stock are sold by the government, by companies, by municipalities to acquire new capital. Now, as some examples in the primary market, the government will sell treasury bills, treasury notes, treasury bonds. The Federal Reserve System auctions or sells all of these treasury securities. A lot of municipalities also sell bond issues. Municipalities will sometimes do private placements, sometimes they'll negotiate a sale, sometimes they'll have the securities sold based on a competitive bid. Corporations issue bonds and stock issues. If a company needs new debt money, they'll issue a new bond. They'll go through an investment banker, set the terms of that bond, and then sell those bonds in the market. The same with stock. They'll decide that it's time for a new equity issue, or in the case of a stock that has never gone public before, an IPO, an initial public offering, and they will sell the stock directly to the public through the broker. Now, there's a fair amount of activity that goes on in primary markets, but the real activity, most activity, takes place in the secondary markets. Here, the government and the corporation aren't involved. The secondary market is where individuals buy and sell securities with each other. Again, they're not getting new securities from the corporation. It's as if I decided I've got IBM stock, I want to sell it, I sell it to you. IBM doesn't care. They're not getting any new capital. They're simply switching the ownership paper from me to someone else. So again, in the secondary markets, stocks and bonds that have already been issued are traded among current and potential owners. Now, the secondary markets are very important. They help that primary market. What the secondary markets do is provide liquidity. If you bought stock in a corporation, you might be less willing to buy that stock if you were afraid you couldn't resell it whenever you wanted your money out of that stock. So just the existence of the secondary market makes it easier for investors. They know that when they want to sell their stock or their bond, there will be a market for that. Now, let's look at different kinds of markets. I'd like to look at the differences between call markets and continuous markets. Call markets are used for trading individual stocks at specified times. The purpose of a call market is to gather all the bids, all the buying activity, and all the asks, all the selling activity for that stock. It's an attempt to arrive at a single price that will clear the market. Clearing the market means that buyers and sellers both accept that price. Now, a call market is generally used at the early stages of development of an exchange, when there are just a few stocks listed and a very small number of active investors and traders. Call markets are also used at the opening for stocks on the New York Stock Exchange if there's been a big buildup of buy or sell orders overnight. When this happens, it means that the opening price can be different from the previous day's closing price. This is used most often if trading has been suspended in a particular stock during the day because of some significant new information that enters the market. They shut down that stock and allow the market a little bit of time to absorb that information and then reopen the next day using a call market. Now, in a continuous market, trades occur at any time the market is open. Stocks are priced by auction or by dealers. In a dealer market, this always assumes that some dealer is willing to make a market in the stock. Making a market means that the dealer is willing to buy or sell for his or her own account at a specified bid and ask price. In an auction market, it's assumed that there are enough buyers and sellers to allow the market to be continuous. In other words, when you come to buy stock, there's going to be someone there who will sell the stock. Now, next, what I'd like to do is look at some of the differences between national stock exchanges, regional stock exchanges, talk about what the over-the-counter market is, and the third and fourth markets. Now, national stock exchanges list the largest number of securities. They generally have the most prestigious firms listed on those stock exchanges, and they have a wide geographic distribution of the listed firms. Typically, they have a very diverse clientele of buyers and sellers who use the market. The New York Stock Exchange is the largest organized securities market in the U.S. It has the greatest trading volume of any of the markets in the U.S. In fact, 80% of all shares traded in the U.S. Are listed on the New York Stock Exchange. About 10% of stocks are listed on the American Stock Exchange, and the remaining 10% on all of the rest of the regional exchanges. The dollar value of trading on the New York Stock Exchange is about 85% of the total value of U.S. trades. Note that that 85% is a little bit larger than the 80% of trading volume. This is because stocks with higher share prices tend to be traded on the New York Stock Exchange rather than on the American Stock Exchange or regional stock exchanges. Now, in the New York Stock Exchange, brokers attempt to match buy and sell orders. Now, in the American Stock Exchange, first of all, stocks that are listed on the New York Stock Exchange are not listed on the American Stock Exchange. The American Stock Exchange tends to emphasize the listing of foreign securities, and it contains a major options exchange as well. Now, let's look at the listing requirements for both the New York Stock Exchange and the American Stock Exchange. The New York Stock Exchange requires last year's pre-tax income to be $2.5 million. Amex only requires that net income in the last year or the last two of the past 3 years be $750,000. So you can see that that means you're going to have some of the smaller stocks listed on the American Stock Exchange that could not be listed on the New York Stock Exchange. In addition, the New York Stock Exchange also requires that the pre-tax income in the previous 2 years, before the $2.5 million minimum, have at least $2 million in 2 years before that. New York Stock Exchange requires net tangible assets of $18 million versus $4 for Amex. They require that there be at least 1.1 million shares of publicly held stock, while Amex only requires 500,000.